Welcome back to the deep dive. Today, we're taking all that material you've shared with us on financial statement analysis,
Right.
and we're trying to give you the expert shortcut through all that, complex machinery.
That's the mission, really. I mean, we know these statements can be completely overwhelming,
For sure.
but every single number, every line item is ultimately there for two reasons. First, to help you predict a company's future profits and cash flows.
Okay, the future.
And second, to identify exactly where problems might have popped up in the past.
And it seems like a key thing from the sources is that these tools are kind of useless on their own.
Absolutely useless. You have to hold them up against a mirror.
A mirror, what do you mean?
You have to compare the current numbers to the company's own history, its own
Sure.
trends. And maybe even more importantly, you have to compare them to other companies in the exact same industry.
Context is everything.
It's everything. Without context, a 15% profit margin is just a number. Is it amazing? Is it, just average? So to give you that context, that structure, we're going to walk through three of the most powerful frameworks out there. We have the foundational financial ratios.
Okay.
They're the super efficient common size statements. And finally, the really crucial decomposition tool, which is the DuPont framework.
All right, let's jump straight into the fundamentals then. Financial ratios.
Mm,
Now, for our listeners, these terms are probably familiar, but we're not just going to list off definitions. We want to get to the insight.
exactly. It's about boiling down these massive complex operations into just a few core metrics. Let's look at the debt ratio first.
Debt ratio. Okay. At its simplest, this tells you what percentage of the company is funded by borrowed money.
That's it.
But most people just see high debt and think bad. It's more nuanced than that, isn't it?
Oh, way more. The immediate thing that ratio tells you is about financial flexibility.
Flexibility.
Think about it. A company that's already highly leveraged, let's say a 70% debt ratio, they have very little room to move if things go south.
Or if a great opportunity comes up.
Exactly. They can't just go borrow more money. But a company with a really low debt ratio, say 10%,
They have a ton of borrowing capacity just waiting.
right, and that flexibility is a huge strategic asset.
That's a great way to reframe it. Okay, staying on that structural side, what about the current ratio? This is your quick solvency check, right?
It is. Current assets divided by current liabilities. And this is where we see the first big trade-off in financial analysis.
A trade-off.
Yeah. A super high current ratio, maybe 3.0, looks incredibly safe. You've got 3 times the assets you need to cover your short-term debts,
Sounds great to me.
but it often signals inefficiency
Wait, how can being too liquid be a bad thing?
because that liquidity is probably just sitting in a bank account earning nothing.
Ah.
Or it's tied up in way too much inventory or accounts receivable that you're not collecting fast enough, that capital isn't working for you. A company that's too safe is often a company that's just, lazy with its working capital.
So there's a sweet spot. Safe enough, but not too safe.
That's the art of it.
Okay, let's pivot from structure to performance. Let's talk profitability. We've got return on sales or ROS.
Right, the pennies in profit on each dollar of sales. Your pure margin health.
And then the one that shareholders really obsess over, return on equity, ROE.
ROE is kind of the ultimate report card. It's how effectively management is using the capital that
Yeah.
stockholders gave them.
Yeah.
If you only look at one number, it's usually that one.
But our sources all warn that ROE can be really dangerous if you look at it by itself.
Oh, absolutely.
Because you can manipulate it just by adding more debt. You can pump up that return for shareholders, but you're adding a ton of risk.
Precisely. High ROE can hide some really dangerous leverage, which is why we need to unpack it later with the DuPont framework.
Got it. And the last big one here is efficiency, right? Asset turnover.
Mm-hmm. Asset turnover. How many dollars in sales are you generating for every single dollar of assets you own? Your buildings, your equipment, your inventory.
So high turnover means you're super efficient at using your stuff to make money.
That's it. So you put all these ratios together and you get a baseline picture.
Mm-hmm.
But if you want to compare, say, a small regional company to Walmart,
The raw numbers just don't work. The scale is too different.
you've just hit on the critical limitation of ratios. They don't normalize for scale. And that leads us perfectly to our next tool.
So speaking of tools that solve that scale problem, let's talk about common size analysis.
Yes.
The sources call this the easiest, the most intuitive, and maybe the fastest way to kick off an analysis. Why do you think it's the best starting point?
Because it's the great equalizer. I mean, think about it. You're looking at the raw numbers for a huge company making billions and a tiny competitor making millions. Your brain just can't compare them properly.
Right, a $5 million expense is nothing to one and everything to the other.
Exactly. Common size statements fix that. They normalize everything to one common denominator: sales.
Okay, so walk me through the mechanics of that. How does it work?
It's actually really simple. You take every single line item on the financial statements, I mean everything from cash to marketing expenses, and you just divide it by the total sales for that year.
And that turns every number into a percentage of sales.
It resets the whole board, and what you get is this immediate, crystal clear comparative picture.
So if we look at a common size income statement, what does that actually tell us?
It instantly shows you how many pennies of each expense it took to earn a single dollar of sales.
Ah, okay.
So maybe your cost of goods sold was 60% of sales this year. If you look at your main competitor and theirs is only 50%,
You immediately know you have a problem, an efficiency problem with production or sourcing.
right there. It's that powerful. If a company says profitability is down, the common size income statement is the best tool there is for finding the culprit. Was it shipping? Was it R&D? It just isolates the problem so quickly.
And that same logic applies to the balance sheet, too.
It does. The common size balance sheet tells you how many pennies of each asset you need to generate a dollar of sales.
That seems like it gets right to the heart of a business model's efficiency.
It really does. I mean, if a big tech company needs 75 cents of property and equipment for every dollar of sales, and an e-commerce company only needs 20 cents,
The e-commerce firm has a much more capital-light business. It's more scalable.
and you can spot that difference instantly with a common size view without getting bogged down by the fact that one company is 5 times bigger than the other.
All right, let's zoom back in on return on equity. We mentioned its big flaw that it can be, inflated by debt. And this is where the DuPont framework comes in. It deconstructs ROE into its 3 core drivers. Why is that so important?
It's essential because it forces you to understand the strategy behind the return. It separates the result into 3 buckets: profitability, efficiency, and leverage.
So you know how they got that return.
Exactly. Was it driven by incredible margins or amazing asset use? Or was it just decent margins amplified by a huge amount of debt? Very different stories.
Okay, let's break down the math. It's 3 multipliers, right? The first one is profitability.
That's our old friend, return on sales. Net income divided by sales. It's your pure margin power.
Got it. Second component is efficiency.
And that's asset turnover, sales divided by total assets. It's how effectively you're using your stuff to generate revenue.
And when you multiply those 2 together, profitability times efficiency, that gives you return on assets, or ROA.
That's correct. And that's a really pure measure of management's performance because it's independent of how they finance those assets.
Which brings us to the third piece, the amplifier, leverage.
Leverage. This is captured by the assets to equity ratio. So total assets divided by total equity. This just tells you how much the company is using debt to acquire assets. The higher this number, the more magnified that ROA becomes.
For better or for worse?
For better or for worse.
So you multiply profitability times efficiency times leverage, and boom, you get your ROE number. What's the biggest strategic insight this gives you?
The trade-off. It proves there's more than one way to win. A key takeaway is that companies with a really low margin, think grocery stores, big discount retailers, they can still earn a perfectly good return if they have incredibly high turnover.
Right. So a luxury jeweler might have a fantastic 40% margin, high profitability, but they don't sell that many items, so low turnover. But a big box store might have a tiny 3% margin, but they sell a massive volume of stuff, low profitability, super high turnover.
Exactly. They look like completely different businesses on the surface, but the DuPont framework gives you the language to compare them. Is what turns the raw numbers into a real strategic conversation.
This analysis is really powerful, but we have to talk about the things the numbers don't show us. Let's talk about cash flow.
Right.
Why do cash flow ratios always seem to get, second billing behind the balance sheet and income statement?
It's mostly historical. Analysts have traditionally prioritized metrics like net income because, theoretically, they're a better predictor of long-term economic performance. But, cash is what keeps the lights on.
Cash is king.
It is. And modern analysis really demands that we put cash flow front and center in a few specific situations.
Okay, what are those high-risk scenarios? When do we absolutely have to focus on cash?
There are 3 big warning signs. First is when net income is being distorted by large non-cash expenses. Think about things like depreciation. It reduces your reported profit, but no cash actually leaves the building.
You're right. And the second one is the classic growing broke problem. growing broke, that sounds completely counterintuitive. How does that happen?
It happens all the time. A company's growing super fast, sales are through the roof, but that means they're building up huge amounts of inventory and accounts receivable.
And that all costs cash up front?
A ton of cash. So their cash from operations can be way, way less than their reported net income. They look profitable, but they're running out of money.
And the third scenario sounds a little more sinister. It points to management incentives.
It does. When management has a really strong reason to, let's say, bias reported net income, maybe to hit a bonus target or get a bank loan.
Or issue stock at a high price.
Exactly. Cash flow is the reality check. It's just much, much harder to manipulate cash than it is to manipulate accrual accounting figures.
So after all this work, the ratios, the common size, the DuPont, we still have to be so careful not to base a decision just on the numbers.
That's the most essential caveat. Financial analysis almost never gives you the final answer. It just points you to the areas that need more investigation.
So if there are all these problems, these benchmarking issues, why do we do it?
We do it because it provides the best structure we have. But we have to be honest about the limitations. Comparability is a huge issue. Companies use different accounting methods, different classifications. Conglomerates are almost impossible to compare.
And you won't find one single smoking gun.
Almost never. It's usually a combination of things. Which brings us all the way back to the qualitative factors.
Right.
Things like product quality, management reputation, customer service. Those things are critical. The numbers might tell you where the ship is leaking. The qualitative analysis tells you how you might be able to fix the leak.
Okay, so this deep dive has given you a real structure for financial diagnosis. We started with the basic solvency and structure checks of the debt and current ratios. Then we moved to the comparative power of common size analysis, which just equalizes everything for scale.
And then we use the DuPont framework to really deconstruct that all-important ROE number into margin, efficiency, and leverage.
The key here is transforming a mountain of data into a few structured questions.
But we always have to remember that we are looking at historical data that is based on accounting choices made by the company.
And that leads us to our final provocative thought for you.
Right. So if we know that financial analysis is prone to all these errors and differences in accounting methods, even if you could perfectly standardize all the numbers, we are still just analyzing the past. And that raises a really important question. In a world that moves as fast as ours, how much weight should past performance, even perfectly measured past performance, carry when something is changing right now?
Like a huge shift in the market.
Or a sudden collapse in product reputation, or a competitor launching something revolutionary. The job of a great analyst isn't just to measure history. It's to integrate that history with the immediacy of the present.
An excellent challenge. Now you have the frameworks and the critical lens. Take this knowledge, apply these tools, and you'll find the numbers stop feeling like a test and they start feeling like the most useful conversation starter you can have.